Historically, there was no such thing as a central bank.
Right.
They were all banks.
Okay.
So 350 years ago, roughly, this loan was given by the bank to the British government at a rate of 8%, which is very similar to the rate that you and I would pay today
for home loans.
For our home loans,
Yeah.
right? While central banks do not automatically finance the deficits of the government, but they hold enough government securities in their own portfolios,
Sure.
right, to back the currency that they have issued. So effectively, they are in some senses financing the governments.
Yeah.
What doesn't happen today is what is called an automatic financing of the government.
Right. What makes the central banks so central and so important in our lives? Every 6 weeks, the Fed in the US and the RBI in India announce their interest rate policy, or what is called the monetary policy statement. And I have a couple of friends who actually stay up till midnight to see what the Fed has said, and similarly are glued to the television while the Indian monetary policy is being announced. What makes the central banks so central and so important in our lives? Today, we'll discuss this topic. Welcome to another episode of Open Dialogue. Joining me today is Neeraj Gambhir. Neeraj, welcome to the show.
Hi.
Neeraj is well known to you, so I'll not spend much time introducing him. We'll just dive into the topic. So Neeraj, let's start with central banks, and maybe let's just start with where did this originate from? What is the history, and where did central banks come from?
So that's a very interesting piece of history because historically there was no such thing as a central bank.
Right.
They were all banks, right? And some of the banks over a period of time acquired the characteristic of a central bank.
So you're saying central banks actually emerged from normal commercial banks?
They were
Okay.
banks.
Very
right?
interesting.
They were banks.
Yeah.
Except for some central banks.
Right.
So I'll come back to that a little later.
Right.
But let's talk about the first central bank,
Sure.
or rather the the oldest central bank that is existing today, which is Swedish central bank, right? It's called Riksbank.
Right.
It was set up in 1668 by the Crown after the failure of another big bank in Sweden called Stockholm Bonco.
Okay.
Okay. And this bank was actually set up to take over the liabilities of Stockholm Bonco because Stockholm Bonco failed quite dramatically over a short period of time in Sweden. And interestingly, Stockholm Bonco was the first bank to issue banknotes
Okay.
in Europe. Okay. So initially, Riksbank was set up to take over from Stockholm Bonco and solve for the problems that Stockholm Bonco came up with, or the problems that Stockholm Bonco left in its wake. But let me ask you an interesting question. What do you think is common between central banking and gin?
Central banking and gin. I have no
Any
clue.
guesses?
I have no clue.
Okay. It's called the Tonnage Act of 1694
Okay.
in UK.
Okay.
So the Tonnage Act of 1694 in UK was introduced to put excise duty or custom duty on imported material, imported goods,
Right.
including liquor.
Right.
And beer was one of the items that was imported at the
Gin.
time. Beer.
Beer. Okay.
And because beer became expensive, gin, which was not a very popular drink at the time, started gaining ground. So gin became popular in Britain because beer was being taxed under this act.
Okay.
And interestingly, this act is the act which led to the establishment of Bank of England.
Okay.
So Bank of England was set up in 1694 in UK as a joint stock holding company to basically lend money to the government to finance its wars with France.
Right.
Because Britain was at the time at war with France, and France had a much better naval fleet, and Britain wanted to create an equally powerful naval fleet. So this was the start of that investment, which came from setting up of Bank of England. And in those days, there were various kinds of borrowings that the governments used to do, but this was an innovative borrowing in the sense that this money that Bank of England was supposed to give to the UK government was supposed to come, the interest was supposed to be paid by way of extra import duties to be collected under this Tonnage Act.
Right.
Which is why Bank of England, first charter was actually a Tonnage Act.
Right.
Which obviously got modified over a period of time, so there was no such thing as Bank of England Act. Now, another interesting question. So this bank was set up in 1694 as a joint stock company, and it collected about 1.2 million pounds, which was lent to the government, British government. Can you guess the interest rate?
3%.
8%.
Wow. Okay.
So 350 years ago, roughly, this loan was given by the bank to the British government at a rate of 8%, which is very similar to the rate that you and I would pay today
for home loans.
For our home loans,
Yeah.
right?
Yeah.
So
And that
350
to
years
Indian
apart.
rupees.
And that to Indian rupees.
Yeah.
So 350 years apart, but that's the kind of level of interest rates that was there at the time.
Right.
And that was the quality of British government credit.
Right.
That it could not raise money at cheaper than 8% at the time.
Right.
But essentially, Bank of England was set up not as a central bank, but as a commercial enterprise.
To lend to the British government.
Yes, the primary objective was to raise money and lend to the British government to finance the war, but also the bank was given a limited charter to trade in bullion. It was in 1697 that its charter was revised to start issuing loans and start lending money. So both of these banks, Riksbank and Bank of England, were actually set up as originally as commercial banks.
One completely different, completely parallel anecdote, which again I kind of read somewhere, I think. The other bank that was set up to fund this 100 years war was Bearings, which by the way saw the 100 years war, saw everything that happened, post that, and one fine day, one rogue trader brought it down, and it had to go back.
No, you don't need to go that far apart. Two other banks were set up in the same model in Britain.
Right.
Right? One of them was South Sea Bank.
Okay.
Which later on collapsed under South Sea bubble, right?
Yeah.
So this joint stock company model was actually a very new model at that point in time for setting up banking.
Right.
It evolved over a period of time, but of course there were a whole lot of changes.
Right.
Now let's come to a third bank, which
Sure.
was set up in 1800.
Right.
It was Banque de France, which is basically French central bank,
Right.
set up by Napoleon himself.
Right.
And the main purpose of setting up this bank was to essentially make money supply elastic. Make sure that the money supply in the system expands in line with the economic requirements. And the main purpose of this bank was to provide capital credit for the growth of French economy after revolutionary wars.
Right.
Right? So that was the third example of a central bank. Fast forward another 100 years. In 1913, Federal Reserve Bank of US was set up.
1913.
1913. Federal Reserve Bank of US was set up after a large number of banking crises and panics in US, the largest of which happened in 1907, exactly 100 years before 2008 financial crisis. So 1907 financial crisis in US led to establishment of Federal Reserve System in US. And Federal Reserve System is not a single bank. It's actually 12 banks.
Right.
Right? So if you see the history over about 300 years, we looked at establishment of 4 banks with 4 very different purposes. Basically to take care of the panics and crises and runs in the banking system, to finance the government, to provide credit for growth of the economy, right? And to provide stability to the economy. Today, over a 350 years history of central banking, these have become the cornerstones and the uses of a central bank today. Of course, today's central bank looks very different from central banks which were set up way back 300 years ago. Can you tell me one fundamental difference in the way the banks were set up, central banks were set up in 350 years ago to now?
Clearly, they don't do any commercial activities.
That's one, clearly. They don't do any commercial activity.
I can't think of.
Yeah. So Bank of England was set up as a joint stock company
Right.
with a large amount of shareholding in private hands.
Right.
Right? Similarly for the Riksbank, similarly for Banque de France. But nowadays, central banks are almost entirely owned by the governments.
They have to be, right? Like, I assume there is no, at least I can't think of any central bank which is not publicly owned.
The biggest of them.
The Federal Reserve continues to be a.
So the Federal Reserve,
Yes.
the 12 regional banks of the Federal Reserve are owned
by the banks.
by the member banks.
Yeah, by the member
right?
banks,
So it's
yes.
again very different structure
Yes.
of ownership in the case of Fed as compared to what I call as the European model of central banks, right?
Right.
But by and large, its central banks have today become a part of the government,
Right.
effectively, almost complete government ownership, but separate from the government,
Right.
right? So inside the government, but independently managing monetary policy. So that's the essential feature of today's central banking. But it's quite interesting to see how it has evolved over the last 350 years.
No, absolutely. I think just most other industries don't have a central quote unquote bank equivalent. And it's very interesting that something of this nature should emerge in banking and financial services. I guess primarily because the risk of something going wrong is extremely huge to the economy. And secondly, you need somebody to, each of these functions you named, like creation of money, financing the government, regulating the banks, keeping the foreign exchange, kind of managing the foreign exchange and so on and so forth. Each of these requires like an independent central authority, and I guess that's where.
It's basically how the capitalistic societies themselves evolved
Right.
over a period of 300 years. The role of money in the economy evolved, right? Innovation happened, and some of the pitfalls of, let's say, paper money
Right.
were sort of experienced during this period of time. So, for example, the Riksbank, the bank which was precursor to Riksbank, the Stockholm Bonco, it failed because it printed just too much money.
Right.
And when people started to withdraw that money in exchange of copper coins, it just didn't have enough copper coins to lend. So there were excesses at the time in the banking, which led to a whole lot of problems of confidence, whole lot of problems of availability of credit and economic crisis.
Absolutely.
So in some senses, the roles of central bank today have evolved as a sort of learning from these crises and innovation as a result of these crises.
Absolutely, Neeraj. So let's move on a little bit and just let's talk about the roles of a central bank and what do they do and what all roles do they play.
Yeah. So I think, as I mentioned, that different episodes in the history have led to different kinds of central banks, right? And in some senses, if you look at modern central bank, all of these reasons why the central banks came into play are kind of folded into a central bank today. So the first and foremost is basically creator of credit,
Right.
or creator of money, right? And we are in a fiat economy, right? We are basically in fiat money system. So central banks today effectively print notes, print currency, and ensure that there is faith in that currency, right? And people trust that currency to be able to, use it for their day-to-day economic transactions and as a store of value, right? And they do that, and this entire function of creating money and making sure that there is faith in that money, there is trust in that money, is effectively a monetary function of a central bank, right? So that's the primary part. The second part is that the central banks also manage the payment and settlement system of a country largely, right? So whether it is RTGS, NEFT, check clearing, electronic clearing, all of these modern payment systems are effectively managed by the central banks today, because just as we need to have faith in the currency, we also need to have faith in these systems to make sure that our payments are getting done effectively.
Yeah, and in each of these payments, since there are two independent counterparties, there needs to be somebody in between.
That's
who
right.
both parties can trust.
So the central role, the role of central clearing, right?
Absolutely.
Although central banks themselves don't do that, in many cases there are other entities who
subsidiaries or
do
whatever,
that.
yeah.
But the overall management and supervision of the payment system is effectively an integral part of a central bank today. The third is the reason for which Bank of England was set up,
Right.
which is basically as a banker to the government.
Right.
So historically, the role of these banks was to provide credit to the government. That role has changed. It's not necessarily providing credit to the government, but facilitating borrowings of the government and being, in general, a banker to the government, right? Taking care of government's banking needs.
So most central banks would not directly lend, but they will help the government borrow by kind of issuing bonds. Or
Yeah,
whatever.
it's a bit complex in the sense that while central banks do not automatically finance the deficits of the government, but they hold enough government securities in their own portfolios,
Sure.
right, to back the currency that they have issued. So effectively, they are in some senses financing the governments.
Yeah.
What doesn't happen today is what is called an automatic financing of the government,
Right.
in the sense that it is not automatically funded by the governments are not automatically funded by the central banks.
Right.
So that's the third key aspect. The fourth key aspect is regulating the financial system and, importantly, regulating the banking system, right? So in some senses, although different countries have different setups and different regulatory architectures, but in most countries, central banks are involved in giving bank licenses, bank charters, and making sure that banks are sound. And in that context, also providing lender of last resort functionality. I'm sure you've heard of lender of last resort.
Yep.
Right?
But I think we'll cover this in more detail. But essentially, when there is no one else to lend, the central bank becomes kind of the backstop and lends to the banks when they are in a spot of bother, let's say.
Yeah. So the story on this is basically the 1907 crash in US, when there was so much of confidence of crisis that JP Morgan, the legendary banker JP Morgan, decided to actually create a syndicate of banks and lend and provide liquidity in the system to bring the confidence back into the economy, right? Those days there was no central bank in US.
Right.
So it could not provide the lender of last resort functionality. It was done privately by a bunch of bankers. Today the same functionality sits in the hands of a central bank.
Fantastic. So why don't we kind of go through each of these functions and dive a little bit into detail, and let's start with the monetary side first. And I guess on the monetary side, printing money and kind of ensuring enough adequate money supply is one. I mean there are, I guess, multiple things, but all towards one objective, which is to maintain the level of inflation and growth in the economy. There are, I would say, conflicting.
Yeah.
So first, Neeraj, will be just helpful to understand why are these two objectives, quote unquote, considered a little conflicting, and then let's get down into how does a central bank manage these kind of conflicting priorities.
So if you think about money, and again the shape and form of money has changed over a period of time, and there's a whole lot of that you've covered in your previous episode, so I'll not delve too much into that, but just to bring that context in, there was a point in time when central banks used to issue banknotes, but these banknotes were backed by something
Right.
in their hands, which used to provide the collateral for these.
As an example,
issuance of gold.
Yep.
Right. So we used to have gold, but interestingly, if I go back to 1694 Bank of England example, the initial loan that Bank of England gave to the government was used as a collateral, or was used as a sort of underlying for them to issue banknotes in the industry.
Right.
So historically, it's not just gold as a collateral, but also lending to the government that they have done, or government loans that are sitting in their hands are also used as a sort of underlying for issuance of banknotes. But because banknote is fiat currency, right? It is a trust-based system. A central bank has to ensure that the amount of banknotes or its derivative, which is credit, in the economy is well managed. If it is not well managed, if there is too much money supply in relation to the amount of, the amount of production of goods and services, what you will get is basically inflation, right?
So there is, let's say if the value of the goods being produced is 100 rupees, or 100 units, let's say, just as an example, but the central bank has printed 200 rupees or 200 units, and so you have some, I have some, other people have some, so we will all go and bid for this product, and hence the value will go up.
Yeah, that's a simplistic explanation.
Very simplistic, yeah.
To say that if the amount of money available in the system is in some senses far higher in relation to the amount of goods and services being produced, then you will have a lot of money chasing this limited amount of goods and services, and the prices of these goods and services will go up,
Yep.
which is effectively what we call as
Inflation.
Right? So, and if you have too much inflation, which is the term for too much inflation is hyperinflation. If you have too much of that inflation, you basically the people tend to lose trust in the currency of the market,
Yep.
right? So effectively,
we've all heard stories of how between the morning and the evening, prices have doubled, and hence, effectively, the money that you have in your house is worthless.
Yeah.
And you know that this is going to happen, so you go and buy stuff,
Yeah.
which makes the process of the value of money depreciating even faster.
That's right.
So instead of evening, it maybe now happens in the afternoon.
Yeah, it becomes
It's a vicious cycle.
self-fulfilling
Yeah, it's a
prophecy,
self-fulfilling.
right?
Yeah.
Yeah, but we've seen it's not just that there is a change in the value of the goods and services and people's behavior change. It has a huge social impact.
Absolutely.
Right?
Yep.
Think about Germany of 1920s,
Right.
which had hyperinflation, right? One of the reasons the Nazi party came into the power was because Germany was going through so much of social unrest, or rather so much of social impact of that hyperinflation.
Yep.
So inflation, therefore, is a very, very difficult and a difficult kind of an animal to deal with, and it has a lot of repercussions. So therefore, one of the primary role of the central bank is to make sure that the amount of money available in the system is at the right level, so as not to destroy the value of the currency and effectively maintain the inflation in the economy, right? And to do that, they use multiple tools. One, they control the amount of money that is getting created in the system. I won't use the word printed, because nowadays the printing can happen in multiple ways,
Sure.
and not all money is printed money. US, for example, the printing of the money is done by the Treasury, not by the central bank, right? But it's creation of the money in the system. And the second, so one tool is the amount of money that is being created in the system. The second is the price of the money, right? The rate at which the money is changing hands, the rate at which you are willing to borrow or lend. And that's the interest rate tool, right? So over a period of time, I would say the thinking in the central banking has changed to say that what has become more important is the price of the money rather than the quantity of the money, right? And that is effectively has become nowadays the main tool for central banks to manage the amount of liquidity, credit available in the system. And why do they do that? They do that because they want to control, or they want to minimize, the boom and bust cycles in the economy. They want to ensure that the business cycles in the economy are very, very stable in some senses. So that's the monetary function. Again, there is a lot of technicality here that I'll not go into.
Absolutely. And we'll get into some nuances.
Yeah.
But the other question is that conventional thinking is that, interest rates and economic growth, or more kind of technically put, employment, are inversely correlated. That, higher the interest rate, worse will be the employment, and vice versa. Why does that happen?
It's a complex relationship in the sense that and it's not always very the causality always doesn't necessarily run one way to the other. It can, over a period of time, these relationships have actually undergone a lot of change. But the broad thinking, and which is what is called the Phillips curve, right, is that as you increase the interest rates in the economy, the cost of money becomes higher, and some of the investments which would have been profitable at lower interest rates will no longer be profitable at higher interest rates.
Right.
So effectively, as you raise the cost of the money, you reduce the level of investments that can happen, and as a result of that, you reduce the level of economic activity, and investments, economic activity ultimately affect consumption, and hence you basically affect the overall economic growth, which effectively is in some senses measured through employment rate.
Right.
So the more an economy is booming, the better is the employment situation in that economy, right? So employment rate is more of a measure of the strength of the economy. And there is a negative correlation. Higher interest rates means lower economic activity, lower employment, and lower interest rates means some kind of a push to create more economic activity. The thought process is that there is a level of economic activity in an economy which is consistent with stable and low level of inflation. If the economic activity becomes higher than that particular threshold, inflation starts to pick up, right? Therefore, the relationship between inflation, economic activity and interest rates. The tool is the interest rates. The ultimate objective is to make sure that the economic activity does not go through boom and bust. And the intermediate variable, as they call it, is inflation.
Yep. So just to kind of again reframe it a little bit, let's take the example of housing, right? Now, if let's say 100 units of houses are being constructed and they are being bought, now if the central bank raises the interest rate, both for the developer to build the homes as well as for the consumer to buy the homes by taking a home loan becomes more expensive. And hence either consumers will downsize or they will postpone their decision of buying the homes. And hence the entire industry, both on the demand side and the supply side, will see a little bit of a slowdown. Conversely, if the interest rates were reduced, it is cheaper now for people to buy homes as well as it's cheaper for, let's say, builders to build more homes. And so we should see a increase in activity.
That's right.
Now a central bank would say, look, there is an ideal rate basis how the economy is doing and what's the growth in people's salaries, how affluent they are, etc. There is an ideal rate at which this construction activity should ideally go, and so they will try to keep the interest rates at a level where it is neither overheated nor not too cold.
Yeah.
And the reason they focus on inflation perhaps also is because actually higher inflation impacts the less well-off consumer far more than the better.
Yeah, I mean, one way to think about inflation is that it is a tax.
It's a tax, absolutely.
Right? Effectively, you are losing the value of your savings by the amount of inflation every year.
Correct.
So the higher is the level of inflation in the economy, the higher is the loss of your savings. So effectively, you are getting taxed, right? And the cost of that tax or the impact of that tax is far higher on the lower strata of the society as compared to the rich. And therefore, inflation is also what is called a disproportionate tax on the poor. Yeah, but therefore the social impact of inflation. So we'll not spend too much time on inflation because
absolutely.
we don't want to carry it away in discussing inflation.
Right.
But the main objective of central bank therefore is to make sure that the economic cycles are not too sharp. You can't say that we will not have any economic cycle, but you want to make sure that they are not very sharp economic cycles.
Right.
And you do that by way of managing the amount of money supply in the system and the cost at which the money is getting borrowed or lent and the rate of interest in the economy. Right?
So let's move to that now, Neeraj. Now, interest is the primary tool, as you said, right? And as I spoke, many folks just kind of stay awake late night watching what Jerome Powell is saying about the US interest rates, or in the mornings what our governor is saying about our interest rates. Now, what is this what is this interest rate? They talk like our RBI will talk about an interest rate which is in the 5.5 kind of a bucket. Though even the cheapest loans, like home loans, are perhaps the cheapest loans, they go at 8.5. So what interest rate are they actually talking about? Yeah,
so it's basically called policy rate.
Right.
Policy rate is some kind of an anchor in the system, and if you're a bank, you are lending to another bank, so you have surplus liquidity, you're lending to another bank. The rate at which you lend to another bank for one day, right? In many countries, that becomes the anchor policy rate.
Okay.
Right? And because it's an interbank lending and borrowing, and it's a very short period, overnight kind of a lending and borrowing, it sets the sort of the floor at which the rates are transacted, at which the rates are set, right?
Right.
And everybody else borrows at and lends at rates higher than this rate.
Right.
Because typically you would borrow for a longer term, and second, you're not interbank risk, you are a slightly different credit risk, right? Therefore, there will be a charge for that. So in some senses, this is the anchor rate which sets the floor at which rates are set in the economy. And as the floor is raised or dropped, the rest of the interest rates in the economy move in tandem with this. May not necessarily by the same amount, but they move in tandem with this. So what the central bank hopes to achieve is through its so-called policy rate, and this policy rate is not necessarily the same across all countries. Different countries have different policy rates. It tends to influence the rest of the rates in the economy. So if, let's say, Reserve Bank of India hikes the policy rate by 100 basis points, right? It sets the floor at which rates will start getting, the money will get transacted amongst the banks. So if I as a bank have to lend it to someone other than a bank, I definitely would lend it at a higher rate.
Right.
Right? Or if I have to lend it longer for a day, I will definitely lend it at a higher rate. So in relation to that rate, then the rest of the rates starts moving up and down, which in turn, as we discussed, affect economic activity.
Sure. So let's kind of dive a little bit into this. So when the RBI announces rates, they announce the repo rate and the reverse repo rate. So firstly, what are these? What is a repo and what's a reverse repo?
So repo rate is very simply the rate at which, if you are a bank and you have government securities, you would go to RBI and say, I want to borrow money from you. This is the rate at which, I'm simplifying it, this is the rate at which typically Reserve Bank will lend you money.
Right.
Right?
So if the repo rate is 5%,
yeah,
and Axis Bank now wants to borrow from RBI, you will go to RBI and say, here's 100 rupees worth of government securities. Against that, RBI will say, okay, here is 100 rupees worth of cash, but please give me 5%,
5%
annualized interest.
Annualized interest rate, right, for 1 day.
Right.
Right. So that is what is repo. Repo is basically repurchase agreement. It's effectively designed as saying that I will sell the security to the Reserve Bank and buy it back from them the next day. But effectively, it's a collateralized borrowing transaction.
Right. So you will sell it at a certain price and you will buy it at a certain higher price, so that
then the net cost
is basically 5%.
Is basically 5%. That's right. And reverse repo is the other way around. When I have the money and I want to lend it to the central bank, that's the rate at which the central bank will borrow from us, or Reserve Bank will borrow from us, right? So repo, reverse repo are basically the two sort of, I would say the two defining corridors, the boundaries of the policy rate, right? But policy rate is usually only one, and in the Indian context, it is the repo rate.
Right.
So whether it is repo rate or whether it's weighted average call rate or interbank rate, I think that's not important. The tool is not important here.
Yep.
The concept is, which is to say that it is the 1 day interbank borrowing and lending rate, which sets the floor for all other rates in the system.
Right. Now, so two questions from this. First is, how does the central bank influence the interbank rate? Repo, I understand. It's a diktat, right? Like if you give me the money, then I will give you so much interest rate. Or in the case of repo, if you want to borrow money from me, you will get it at 5% only. So it's a mandated rate, and hence it is kind of set. But first, like interbank, how does kind of the central bank?
That's where the quantity of money aspect comes into play, right? So if I want a certain rate to stay in the system, I need to modify the quantity of money in the system in such a way that becomes the rate.
Right.
And I'll keep on fine-tuning the quantity of money in the system till such time, let's say in the case of India, 5% or currently 6.5% becomes the rate at which the system transacts in itself. And that modulation of quantity of money is done by the central bank through a variety of tools, right? A very important tool there is what is called open market operations.
Right.
And open market operations basically means that the central bank is using its own portfolio of securities to buy and sell them in the market. And as a result of that, it changes the amount of money which is available in the market so that the rate starts, settling towards the target policy rate.
So just kind of to clarify, let's say central bank says that policy rate is 6%, and now they see that actually banks are actually transacting at 5.5%. So they will go and they will find ways to suck money out of the system.
That's right.
So that the interest rate automatically
starts rising
and comes up to 6%.
That's
and when it comes to 6%, they will then stop kind of taking money out.
Yeah. So,
and to suck the money out, they will basically go and sell government bonds.
So they have government bonds in their portfolio.
Yeah.
When they sell government bonds, the banks who buy the government bonds have to give the liquidity back to the central bank.
Absolutely.
Right? So effectively, it's a liquidity withdrawing operation.
Yes.
So as a result of that liquidity withdrawing operation, the amount of money in the system starts coming down, and the price of the money starts going up.
Yep.
Right? And it's almost like, you keep on trying to fill a bucket
Yep.
which has multiple holes in it. You keep on changing the amount of water that goes into it till such time the inflow and outflow balances, and you have a certain level in the bucket, right? So it's a very fine-tuning day-to-day operation that the central bank conducts to make sure that the money in the system or liquidity in the system is such that the target policy rate is the operating rate
is met, and there are multiple tools to do that.
Yeah.
The second question is that how does this rate translate into the home loan rate? Because frankly, at the end of the day, banks are in most markets privately owned independent entities with the ability to price whatever they would like to price to their customers. So why would change of this interbank rate result in a change in the home loan and auto loan and corporate loan rates?
Yeah, because in some senses, this is the rate at which I can create liquidity.
Right.
Or I can borrow at the margin money as a bank. This is the lowest rate at which I can borrow the money.
Yeah.
Right? And because this is the lowest rate at which I can borrow the money, everything that I do has to be priced in reference to this. Right? So for example, if I am lending money to a bank at 6.5%, when I lend money to Samir, I'm not going to lend it at 6.5%.
Yeah, absolutely.
I'm going to add some risk premium to that because the bank may not default, but sorry to say this, but Samir may default, right?
Yeah.
So therefore, we need to price in the credit risk aspect of it, right? The second is that the policy rate is effectively overnight rate.
Right.
It's a rate for one-day lending. But when I'm lending to you for a 10-year period to build a home or to buy a home, I'm actually locking in money for a longer period of time. So I need to charge certain premium over and above this overnight rate, which is called the liquidity spread or the term spread, to justify locking in my money for 10 years, right?
Right.
And most of these aspects like credit, risk premium and the liquidity risk premium, there's some scientific theories about it, but it's also a function of the demand and supply in the system.
Absolutely.
Right?
Absolutely. So just conceptually, if I take this to a manufacturing context, there is a raw material and then you do some operations on the raw material and then you sell your final product. If as an example, I were manufacturing this piece of paper, then the cost at which I get the pulp plus a certain amount is what I have to sell at. Because if I don't sell at that amount, then I'm making a loss. And so if the cost of the pulp goes up, I have to sell the paper at a higher cost or take a hit on my margins or make losses. And in the context of banking, the cost at which I am getting the money is the raw material cost. And so,
Yeah. So effectively, both sides of the balance sheet, the raw material side of the balance sheet and the final product side of the balance sheet, right? The raw material side of the balance sheet is deposits.
Yes.
And the final product side of the balance sheet is lending.
Yes.
Right? Both of them are in some senses linked to the same floor rate that the central bank has set.
Absolutely. Yeah.
Because you think about this, if the central bank has set the floor rate at 6.5%, then when I have to borrow money, the lender on the other side or the depositor on the other side will also demand some premium over this rate because this is absolutely the lowest rate in the system, right? At this rate, a premium over this rate for locking in money with me for a period of 1 year or 2 years or whatever the term is, right? Therefore, I think both sides of the balance sheet start linking to the rate at which or the central bank's policy rate.
Right. And in previous episodes, we've also covered why this conceptual framework doesn't really translate to reality. And which is why, like as an example, the RBI has come up with all this earlier, the PLR and then the MCLR and the EBLR and so on and so forth. Now almost kind of linking, explicitly asking banks to link the final rate to the policy rate so that the transmission is fully complete. So we'll not dive into that much in this episode since we've already covered it. So last question on this monetary front, Neeraj, what other tools does the central bank have outside of the policy rate to manage the monetary conditions? And when do they use it? And like maybe one or two examples of when they
Yeah,
use it
so
in India.
there are multiple tools. First of all, we are in what is called a fractional reserve banking system.
Right.
Which means basically we all set aside certain amount of reserves and we rotate the same amount of money. We just keep on rotating the same amount of money, and every cycle we need to set aside a certain amount of reserves. What is the amount of reserves that we have to set aside is decided by the central bank.
Right.
And by influencing this amount of money that has to be set aside, the central bank basically controls the amount of credit creation in the system.
Right.
Look, the ultimate goal of monetary policy is to influence the credit creation in the system.
Yeah.
Right? So that's one tool. The second tool is that a central bank can actually tell the banks as regulators that do this, don't do that.
Right.
Right? So, for example, don't lend for real estate.
Right.
Don't lend for investments in stock
Stocks.
market.
Yeah.
Right? So
Or
some of these
Lift
rules.
the risk weight for unsecured. By
Yeah, I mean,
25 basis points.
risk weight is a derivative of saying something.
Sure.
But for me, it's basically telling people what to do and what not to do.
Yep.
And by that sort of direction, it also influences the amount of
Credit in
money
the economy
creation,
and money
credit
in the economy.
creation in the system. So it's again influencing the quantity of money in the system in a regulatory sort of a way. So that's the other tool. The third tool, in many cases, particularly in emerging market economies, central banks are also active participants in the foreign exchange market.
Right.
Because they are not only trying to maintain the value of their currency from a domestic inflation perspective and domestic sort of purchasing power perspective, they are also trying to make sure that the value of this currency is preserved or maintained from a external world perspective. So when the central banks buy and sell foreign exchange to manage the value of their currency, they also influence the amount of domestic money creation, domestic liquidity, right? So that's the other tool that the central banks tend to use. So typically you will see central banks use a combination of these tools to get their monetary policy outcomes. Idea is, as I say, idea is to control the supply of money in the economy in such a way that it is consistent with a particular level of economic activity.
Right. And this, kind of some of the terms that have become really, really popular is quantitative easing or quantitative tightening now. So these are these already included in the tools that you mentioned, or these are?
It's just that what takes primacy in the sense that, the workings of a central bank have evolved in such a way that the dominant dogma, as I would call it, was that we just keep on influencing interest rates. So we set the level of interest rates and we basically influence the rest of the system by changing the liquidity in such a way that this level of interest rates is achieved. And that's our primary goal. We don't want to bother about how much money is there in the system because it will find its own, level. But once you had the interest rates going down to a level of 0%, it is called the zero bound, that flexibility of managing the economy through interest rates went away.
Right.
You can't cut interest rates beyond zero. Actually, it's not true. Some of the central banks have experimented.
But some
with
banks said
negative,
no, let's not go there. And
some have also experimented with negative interest rates.
Yep.
For example, Bank of Japan.
Yep.
So when you reach that kind of interest rate level, the ability of a central bank to use interest rate tool to manage the economy becomes very limited, right? It's kind of at the end of that capability. That's the time when the central bank says, okay, now I will just flood the system with money. Right? Which is what essentially JP Morgan did in 1907, flood the system with the credit so that it finds confidence. The confidence comes back, demand comes back. That's exactly what quantitative easing is. Create more and more money to bring demand back into the system, to bring confidence back into the system. And quantitative tightening is actually the reverse of it, which is basically reduce the amount of money in the system.
Understood. Great. Thanks, Neeraj. With that, we come to the end of this episode. Today, we discussed the history of central banks, the various roles they play, and particularly we dived onto the monetary role that they play and various tools they use to control the monetary policy of any country. It was a very exciting topic. I hope you liked it as much as we liked bringing it to you, and look forward to seeing you in the next one. Thank you.